Welcome to Mortgage Minutes, where we demystify the loan process. For you, I'm your host, Austin Baker, along with my co-host, Jonathan Bond. Woo, 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 woo. All right, what are we talking about today?
So Austin and I get this question pretty frequently sometimes. What's the difference between my interest rate and the APR? And so we're going to shoot a quick video today to kind of talk about that.
Yeah, that's a big one, and most people don't understand it. They know that they exist, but it's really hard to explain APR. Even for lenders, sometimes we have a hard time explaining exactly what that is.
So Austin, let's talk about the interest rate with everybody. Kind of what's that?
Yeah, so the main thing everyone wants to know is, what am I paying? What is driving my monthly payment? And the answer to that is simple. It's the interest rate. So the rate is what drives your monthly payment. It's the rate of the loan amount that you're borrowing is what drives the monthly payment, not the APR. Whatever the APR is, that's not affecting your monthly payment. It's the interest rate. So that's easy out of the gate. How's my monthly payment calculated? It's the interest rate on the loan amount.
Yeah, so most people get that one. But the APR is an acronym for annualized percentage rate. And so how do we explain what APR is to most folks?
So the way that I think about it is, imagine that you were buying a house in cash, right? So if you're buying a house in cash, you're still going to have some closing costs you have to pay for.
Yep.
But if you are financing it, there are different additional costs. You're going to have your lender costs. You're going to have some other third-party service provider costs. And then there's going to be things like mortgage insurance and how you're structuring it that are going to affect your APR. And so what the APR is doing is it's taking those costs and it's expressing them as a percentage and adding them onto the interest rate.
Gotcha. So just think about it. It's your closing cost expressed as a percentage. So that's the APR in a nutshell.
Yep.
But why do you think our industry came up with APR? What's the purpose of APR?
Great question. So the reason APR exists is to help you shop from one lender to the next, because virtually any interest rate is available. And so it's not about what lender is giving you the lowest rate, it's what lender is giving you the lowest rate with the lowest closing cost package. And an easy way to see that, if it's calculated correctly, is to look at the APR. So we wrote up a little scenario here. We got lender one, we got lender two, and let's just imagine for this scenario that you're looking at an interest rate on your loan package of 3% with both lenders. The question is which lender is cheaper? So we'll just imagine that the APR for this guy is, we'll just say it's 3.354%. APR is always a weird number, whereas interest rates are they're in eights. So 3 3.125, 3.25. But because of your closing costs, it's always going to be a funky little number. And then for lender two, let's say that this guy is 3.241%. Okay.
Yeah. So knee-jerk analysis, this lender two looks like it's a better option.
That's right. And so that's what APR exists for, is for you to be able to look at and go, okay, both guys are giving me 3%, but this lender is seemingly giving me the 3% for less.
Yeah, and it could be a bunch of different things. It could be the origination fee that lender's charging. It could be the way the mortgage insurance is set up, or what kind of pricing that lender has access to. It could be per diem interest, all sorts of different things.
It's a big one. If there's any points associated with the rate. And that's really what it's supposed to, I think, show you, is primarily the impact of points from one. But there's so many ways to package your loan together that per diem, I mean, just before we even started shooting the video, you brought that up. I mean, just changing it from the 31st to the 1st.
Yeah, it could increase your closing costs, but then you get to skip a mortgage payment,
Yeah, so it's not exactly an apples to apples comparison. So what do we like to do instead?
Yeah, so we don't like APR from a lender to lender comparison. I think getting a fee sheet or a loan estimate from that lender and actually walking through the math, and even some of that can be complicated, but a good lender can walk you through the math, walk you through the fee sheet, and show you in apples to apples what this rate is, what the cost of it is, so you can really get a good comparison. So that's what we like best.
Yeah, exactly, because the APR, again, is not what you're paying. This does not mean that this guy's going to be cheaper monthly than this guy. This guy might actually
payment's going to be the same.
The payment's going to be the same on the size of the mortgage, but if this guy's doing upfront mortgage insurance, I mean, your monthly payment might be a whole lot cheaper with this guy total than with this one.
Yeah, this
so
one could be monthly.
just because the APR is less does not mean that it's necessarily the most advantageous way to go. Now, all lenders have to disclose what the APR is on their structure, but again,
they could be structured differently. So.
Exactly. So our recommendation is make sure you get a fees worksheet or a loan estimate, and try to get a good side-by-side comparison going on what costs are involved. Because the other thing with APR is depending on what system the lender is using, they might have to be manually calculating their APR. Our system does it automatically for us, which is beautiful.
Yeah.
But there's a lot of room for human error in calculating the APR if you're having to calculate it. So anyways, be careful with APR. That's the difference.
Yeah, so just think about interest rate, monthly payments, APR,
Closing
closing costs. That's it in a nutshell. So
we'll see y'all around.
peace.